Hey, it's Tom here and welcome back to the channel. It's been about 3 weeks or so since I uploaded a video on this channel, and it's been a little over a month since I've stood in front of a camera and actually recorded a video. So fresh back off a extended kind of summer break, which has been fantastic. Some kind of rest and relaxation and sun. But it's time to get back into it for 2022. And it looks like one of the big topics here on YouTube that is kind of taking over the finance community already is this idea of a big 2022 stock market crash happening. And, you know, potentially we're already in the middle of that crash beginning. We've got the S&P 500, the Dow Jones Industrial Average, and the NASDAQ all over in the US, the three main indices in the US, down fairly significantly for the start of 2022. And we've got some particular sectors, mainly sort of the high-flying tech and software as a service type businesses, really getting hammered even more than the headline kind of indice numbers might suggest. And when we do have situations like this happening in the market, we can see some YouTube channels and some individual investors start to get really hyperbolic and really kind of panicky in a lot of their investments. We've seen like Meet Kevin, for example, one of the biggest finance YouTubers on the platform, basically liquidate his entire portfolio and then even put a small percentage of his portfolio towards shorting the market. And as I'll talk about further in this video, there really is a lot of temptation to act and do kind of stupid things with your money when markets are super volatile, whether that be up or down. So in this video, I want to basically just talk through some fundamentals of stock market crashes more generally and some of the actual positive things around stock market crashes as well. And then I want to talk through some of the more practical things that I'm doing in my portfolio and in my investment research to try and potentially take advantage of any opportunities that might come up. Like I say, I think there's a lot of temptation to act, and there's some very clickbaity videos, you know, floating around YouTube at the moment. So hopefully we can kind of pull everyone back to earth and have us all behaving fairly rationally with our money following this video. So if you do enjoy it, please hit like and also subscribe to the channel if you're new here. But with all that said, let's get straight into it, and I hope you enjoy. Okay, so the first thing I just want to get out of the way is quite a simple one, but people often tend to forget it, is that no one knows when the market is going to crash. No one can time the top, no one can time the bottom, and basically trying to ask different people's opinions on whether they think we're at a stock market top or bottom, or they think it's going down further, is basically a pointless exercise. So firstly, if you're watching a whole bunch of videos on market predictions and watching talking heads on CNBC and so on, I don't think that's a particularly useful way to spend your time. There's kind of two broad investment strategies, I would say, that most of the people that watch these types of videos tend to stick to. Either you're a passive index fund investor, in which case your superpower is just to consistently buy an index fund over time and not really care about what stock market prices are doing in the short term, or you're a picker of individual companies and really broad market valuations, or whether the stock market is flying through the roof, going to the moon, or whether it's crashing, should really have no bearing on whether you make an investment in an individual company. And for whatever reason, when markets do get really volatile, we can often see people who are either passive investors or who tend to pick individual stocks, they suddenly start to move towards becoming more market focused, which I think is quite a strange behavior and probably something that will detract from your long-term results. And luckily for us, we really don't have to look that far back to see what some of the great investors have done through periods of time where markets have been very volatile. We have the very famous stock market crashes of 1929 and 1987, and the dot-com bubble in the early 2000s, and the financial crisis in 2008-2009. And basically all of those have been major historic kind of buying opportunities on the stock market. If you had invested significant amounts of money during any of those periods of time, you would be a very wealthy person today. So that's kind of one thing to note. And the other thing to note is, even with kind of shorter term volatility, take some of the big declines in Chinese tech names, for example, recently, like Alibaba or Tencent. We can sometimes be surprised by the lack of activity that super investors tend to have. They often just kind of stick to the guns and sit on their backside if they own great businesses, and they don't tend to do a whole lot. And that can be really beneficial in terms of sticking to the businesses that you know you got at a good price and you understand really well. And it can also help you you to minimize frictional costs. So take an investor like Li Lu, for example, who manages money for Charlie Munger. He has kind of a China-focused fund, although he does invest in US businesses as well. And, when we were seeing Charlie Munger and Monish Pabrai and Guy Spear and so on start to buy into Alibaba and even Tencent and Naspers/Prosus, if you're familiar with that story in some cases as well, even I was getting really excited to see kind of what Li Lu would do in his portfolio, because he's probably the man with the most expertise in investing in China out of all the super investors that I follow. And I was kind of surprised to see that when a 13F came out for Li Lu during that period, he'd basically done nothing. He hadn't bought any new Chinese stocks or sold any new Chinese stocks that we could see. I believe he did trim BYD, but at least in the US listed Chinese stocks we couldn't see anything. And the only thing he kind of did the next quarter was make a small investment in Berkshire Hathaway. So it's kind of funny to see investors make sort of trims around the edges. And I think it's also a really good lesson that you don't have to be hyperactive to do well in long-term investments. That's actually probably the opposite of what you want to do. And even when markets are volatile, sure, there's opportunities that come up. But if you're already in great businesses that you bought at reasonable prices, you can just kind of sit through these events as well. Now, the second thing I want to cover is that stock market crashes can be really beneficial for long-term net buyers of stocks over time. We've already covered the big stock market crash events where, of course, you would have done well had you deployed a whole bunch of money. That's clearly a period of time where a lot of businesses were trading at undervalued prices and you could get fantastic deals. And that still holds true today. There will be mispriced stocks out there in the market right now. Some of these tech stocks are down like 80% plus in some cases. But it's also good for the net buyer of stocks that are companies, not necessarily individuals. So a really good example actually is Berkshire Hathaway, Warren Buffett's company. They've been buying back substantial amounts of stock over the last sort of 12 to 18 months. They've really turned on the buyback machine. And Berkshire Hathaway has done really well in terms of its stock price performance recently. And that's actually kind of an issue for Berkshire Hathaway. They don't have a lot of other places to deploy their cash right now. We know that Warren Buffett will only buy back his own stock if he thinks it's trading below intrinsic value. And if the stock price continues to run up, it can kind of get away from him a little bit and give him fewer opportunities to continue buying back shares. But if we do have a price decrease for Berkshire Hathaway stock in the short term, he can buy back more shares with the same amount of cash. And ongoing shareholders are left with ownership in a larger proportion of the business over time, which of course will improve long-term investment results. Now, I've already mentioned it briefly here, but one of the main areas where I see a lot of investors go wrong when we have very volatile markets, and like I said at the start of the video, I have no idea whether the stock market is actually going to crash 50% or something, or whether it's just going to rocket back up or go sideways. But when we do have a couple of kind of big down days, particularly if it kind of drags on over even just a few days or weeks, some people can kind of get into this mode, is a lot of people who have a very clear investment strategy, whether that's buying index funds or buying individual stocks or a combination of the two, they can suddenly turn into more sort of macro focused investors. Maybe they're starting to focus a lot on interest rate hikes, maybe they're starting to focus a lot on inflation. And I did a podcast recently with Mitch and Cass Dole, and they've done that same thing, and they've put on a very intelligent hedge. I think they've kind of taken a value investing approach to trying to protect their portfolio. That's not really what I'm talking about here. What I'm talking about is people that will find an individual business that they understand, they know is and it's now available at an attractive price, but then they will stop themselves from buying it because they think the market might crash further, prices might come down further, and that in my view is a big mistake. Now, of course, when macro things get extreme, there's maybe some key elements of a business that you should be trying to get your head around. If we have a lot of inflation, is the business that you're looking at or the businesses that you already own going to be okay? Do they have pricing power, or are they a low-cost producer? Have they got all their capital expenditures out of the way? Those sorts of things on the inflation front. And maybe on the rising interest rate front, can they survive interest rates on their debt going up maybe as much as 3 or 4 or 5% potentially? You have to kind of just stress test those situations, but it really shouldn't deter you from buying a great business at a reasonable price. Now, one of the more practical things that I've been doing in the last few weeks is actually going through kind of my watch list of companies. What I've done over time is I've basically gone through and researched companies as they kind of pop up and I find them interesting. Oftentimes I will come to the conclusion that yes, it's a great business, but it's just too expensive for me to be interested in buying into it right now. And now is a fantastic time to go back through that watch list, as obvious as this might sound, and basically try and get up to speed with where those businesses are. You know, I haven't looked at something like Monster Beverage, for example, which has been on my watch list forever. Haven't taken a close look at that one in about a year or 18 months. So it's a really good time for me to go and listen to some Monster Beverage conference calls, get up to speed with their financial performance, and try to understand what the valuation looks like. And if you're already reasonably familiar with these businesses, that's not going to be a hugely time-consuming task. And, you know, obviously if market prices have come down or if they've stayed flat maybe since you last looked at a business, but the underlying company has continued to grow and do really well, that can potentially be an attractive investment opportunity. If the business is going like this and the stock price is going the other direction, that's where we can potentially make a lot of money, right? So that's something that I'm kind of practically working through at the moment, is looking through my watch list, even companies that I have looked at very recently, like a Curate Retail, for example, is one that I've made a video on this channel about a potential kind of special situation. Chose not to invest in it at the time, but the price has come down maybe 30 or 40% since I looked at it. So potentially one that warrants investigating yet again. And that, of course, goes for not only companies on your watch list, but companies already in your portfolio. It's a really good time to, revalue those. I've got a couple of examples of those in my portfolio. Seritage Growth Properties is one that I've been working through, which is quite a mammoth task to actually value Seritage. I've kind of been going through all the 170 odd properties, and I'll share a video on that coming up here soon on the channel. I've also been looking at Thor Industries. Thor is a stock that I've owned for over 3 years. I think I purchased it in the 60s. It went to as high as 150 maybe 6 months ago, and it's all the way back down into the 80s now, and they're starting to talk about share buybacks at these prices. And also the founder has actually added a small amount to their already very substantial position in Thor as well. So again, it's one I'm reinvestigating. I don't want to be anchored to my previous cost basis. I want to try and think about it rationally and identify whether, you know, paying a higher price than I paid in the past is still an attractive investment opportunity. And the final thing I just want to mention, again, this will sound very obvious to the people that have maybe followed this channel for a long time, or that have followed people like Buffett and Munger and so on for a long time. But I think for whatever reason, when markets get crazy, some of the most obvious lessons and most obvious sort of ideas when it comes to investing can be, your judgment can be clouded by crazy swings in your portfolio or in market prices. And basically, I've kind of boiled the whole investment equation down to buy good businesses at reasonable prices. And the same thing remains true whether markets are going up or down or sideways, or interest rates are high or low. Sure, interest rates change how you might value a company. Maybe you change your discount rate in a DCF or something, but you're still always trying to buy good businesses at reasonable prices, or potentially average businesses at really good prices, and you're always trying to add in a big kind of margin of safety when you do that. And when markets are volatile, you will be presented with opportunities to either buy well below intrinsic value or potentially sell well above intrinsic value. If you're buying into a stock and markets are declining really fast and there's a lot of fear, it's almost a certainty that you will not time the bottom. You probably will be down on positions, but that's just kind of something you have to accept. Just because you're down on a position and you could have purchased it lower than you actually did, doesn't necessarily mean that the price at which you purchased was a bad price. It may have still been very undervalued, and now it's just got even more undervalued. So those are my thoughts on how to invest during a stock market crash. Hopefully that adds a little bit more kind of rationality to just the crazy hype stock market crash videos that sometimes float around here on YouTube. So I do hope you enjoyed it. If you did, please hit like and also hit subscribe. If there's any kind of video topics for 2022 that you'd like to see from me, definitely drop those down in the comments below as well. Love to hear from you there and kind of understand what's on your mind, having not recorded a video for a few weeks here. So I do hope you enjoyed it. That's it from me for this one, and I'll see you in the next video. Cheers.